Good evening, class. Welcome to session one of Mastering Individual Taxation. So, the purpose of this session and of this course, which is an 8 session course, is to help individual taxpayers better understand the types of income tax that affect them, everyday, ordinary citizens, and as well as the types of income and how the government system operates overall. So, for tonight, session one, this is going to be basically an introduction to individual taxation. Our overview is going to be taxation in the U.S., which is going to be very quick and brief. Purpose and importance of taxes. Taxes help support our social programs and things that are available to us as citizens in the United States. We're going to talk about the key taxing authorities. We know who those are: federal and state governments, and I already mentioned types of taxes that affect individuals, and then some basic terminology. So, an overview of taxation in the United States. The taxation system in the United States is a complex structure, federal, state, and local taxes, and it's designed to fund government operations, things like public services and infrastructure. That's why we get taxed in our paychecks and other forms of income to support those services and the systems that we use every day. So the U.S. tax system is primarily based on the principle of progressive taxation, and what that means is that the more income you earn, the higher the tax rates will be, right? So it's progressive. So it's kind of like a step up. Starts at 10%, and the max tax rate is 37% for a taxpayer in the United States. So let's talk about the main types of taxes that affect individuals. And we're going to start with income tax. We all know what income tax is. So a more formal description or definition of income tax is a tax that's levied on income earned by individuals, including wages, salaries, bonuses, investment income, and some other forms of income as well. So there's federal income tax, there's state income tax, and then there's the local income tax. That's imposed, the local income tax is imposed by like cities and local municipalities, like the city of Atlanta or the city of Dunwoody or the city of Roswell. I'm speaking specifically to Georgia because I live in the metro Atlanta area. So just for an example. The second type of tax is the payroll tax. Now, though that's taxes that's withheld from your paychecks. And what's significant about the payroll tax and what makes it a little bit different is the fact that there is something called FICA, which is a combination of Social Security tax and Medicare tax. Sorry about that. So, Social Security tax funds the Social Security program, as you know, for retirees, disabled individuals, and survivors. And then Medicare funds the health care for individuals who are 65 and older. The third type of tax is sales tax. We know that that's a consumption tax and it's imposed on the sale of, for goods and services. It's collected at the point of sale. It varies by individual states and things like that. So, and then the fourth tax is property tax. So if you own a home, you know all about real estate taxes. You know all about property taxes. You know about homestead exemptions and things like that. And they vary by individual states as well. So for property taxes, you pay this amount annually and it's based on the assessed value of your property. So if you own a home and the home is worth, $300,000, you're not being assessed the tax based on 300,000. You're being charged or you will pay those property taxes based on the assessed value, which is usually about 40%. The fifth tax is the capital gains tax. This one can be very tricky. And the reason capital gain tax can be tricky is because most taxpayers, or the majority of taxpayers, don't understand that um, uh, when they are investing in mutual funds and even, sometimes 401ks and things like that, there's a constant exchange going on. So there's constant trading going on. Whether you actually receive the cash proceeds or not, those transactions are taking place and they are considered a barter and exchange. So what happens when that is going on behind the scenes is it's creating either short-term gains or losses or long-term gains and losses. Depending on how long you've held that investment, will determine which type of capital gain you will be assessed. Now, a capital gains assessment you will know at the end of the year because you will receive a 1099-B. That B stands for barter and exchange. So just be aware of that. For short term capital gains, for assets that are held less than a year, they're taxed at the ordinary income tax rate. And that could be anywhere from 10%, 12%, 22, 24, 32, 35, or 37% because those are the ordinary tax brackets, okay? And then there are long-term capital gains. So those are assets that are held for more than a year and they are taxed at a reduced tax rate because you've held those assets longer. So the tax rates for long-term capital gains start from zero and 0, 15%, or 20%, depending on taxable income and the filing status per the IRS. Most people pay no more than 15% on long-term capital gains. Okay. The sixth tax we will discuss is estate and inheritance tax. So, an estate tax is imposed on the transfer of an individual's assets upon their death. So it could be federal, it could be state on some levels as well. So let's talk about for federal. So for federal, the exemption for federal estate tax is $13.1 million per individual. So if it's a married couple, then it's $26.2 million. And that tax rate is 18%, between 18% and 40% on the amount above that exemption. Now, let's be realistic. Most Americans don't fit this tax bracket. Um, so a lot of times this doesn't particularly apply when it comes to most, air quotes, most uh, taxpayers or most citizens. But what's important to note is that estate tax, the estate pays the tax before any distribution to the heirs. So the heirs or the receivers of the property would not be responsible for paying the estate tax. The estate itself would be responsible for those taxes, and then whatever's left out of the estate will be distributed amongst the heirs. As far as state taxes, estate taxes go on the state level, there are 12 states plus the District of Columbia or DC that have an estate tax, and those states are Connecticut, Rhode Island, DC, Hawaii, Illinois, Maine, Maryland, Massachusetts, Minnesota, New York, Oregon, Vermont, and Washington. Washington has the highest estate tax rate coming in at 20%. So the tax rates range on the state level from 10% to 20%. Now, the second piece of this estate and inheritance tax is the inheritance tax. Okay. So this is paid by the person who is inheriting the property, and it does vary by state also. There are 6 states that imposes inheritance tax, and those states are Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. And Pennsylvania comes in at the highest rate of 15%. The tax rates range from 1% to 16%. So again, Pennsylvania comes in at the highest at 15%. The heirs pay this tax depending on their relationship to the deceased and whether it's a spouse or close relative. Most times they will be exempt based on that personal relationship. The seventh tax that we will discuss is excise taxes. So these are taxes on specific goods like gasoline, alcohol, tobacco, and even airline tickets. How does this work? Well, we know that that excise taxes are generally included in the price of the product or the good. The most common types of excise tax are the fuel tax, firearms and ammunition, and airline tickets, as I stated before. Common types of state excise taxes are marijuana in those states where it's legal, gambling and lottery winnings, and hotel and lodging taxes. And then there's the self employment tax, which is the eighth tax for discussion. And that these are taxes for individuals who work for themselves. Um, and the self employment covers the Social Security portion as well as the Medicare contributions. So the self employment tax rate is 15.4%. And the rate consists of two parts: 12.4% for Social Security, which is old age survivors and disability insurance, and 2.9% for Medicare, which is hospital insurance. Now, generally, if you are self employed, you are independent contractor, you work for yourself, and you don't receive that income on a W 2 as running through a payroll process. In general, you should set aside between 20 and 35% of your 1099 income. So that income from freelancing, consulting, or just working for yourself, you should set aside between 20 and 35% of that for this particular tax. And who pays it? I just stated freelancers, independent contractors, and small business owners. But let me be specific about small business owners. This pertains to small business owners who are self proprietors. So if you are the only person that's working for that business, you don't run a payroll, you are a sole proprietor. This self employment tax would pertain to you. The ninth tax is the gift tax. And this is a federal tax on the transfer of money or property to another person without receiving something of equal value in return. So the annual gift tax exclusion is $18,000 per person per year. That would be 36,000 per person, if you are, for a married couple. There are some exemptions. The annual exclusions apply before the tax is levied. In 2025, the lifetime exemption is 13.61 million per person. Per person. That's not my tax bracket. So I don't have to worry about that. If you exceed both the annual and lifetime exemptions, the gift tax rate changes from 18% to 40%, which kind of falls in line with the estate taxes. And then there are the tax-free gift exemptions. So there are spousal gifts. If the spouse is a U.S. citizen, you're exempted from paying a gift tax. Tuition payments that are paid directly to the institution. Medical expenses that are paid directly to the healthcare provider. And charitable donations to qualified organizations. And our 10th and final is the miscellaneous tax. And this covers or includes things like, well, they're considered sin taxes, like for cigarettes and alcohol. And they are imposed to discourage you from consuming these things. And then there are user fees for services like using the national parks and toll roads. And those, national parks and toll roads usually are governed, for the most part, states have their own assessment and user fees as well. So I think the things that we should have covered today in today's session are what are the primary purposes of taxation? We covered that. It is to fund programs. It's to fund social programs. It's to fund government, government and infrastructure like roads, roadways, education systems, and things like that. We talked about the two main primary taxing authorities that we all know, which is the federal and the state system. And then we differentiated between federal and state taxes. So I think that this should be helpful in you taking the first step in understanding individual taxation and the specific taxes that affect individual taxpayers. I hope you find this information helpful, and I hope to see you at our next session next Wednesday at 7 p.m. Have a great evening.